Planning to own an assisted living facility? You might want to think twice. Not because you shouldn't do it, it's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. The pitch is backed by demographics most businesses can only dream of. Over 80 million Americans will be past 65 by 2030. The sector's projected to clear $100 billion in value, and demand comes from genuine need, not a trend that could fade. Here's what almost all of that content is about, though: passive investing. Syndications, real estate funds, limited partnership shares you buy into for $50,000 to $100,000 and collect quarterly distributions from. That's a real path, but it's not the same business as actually operating one. The professionals who actually run these facilities plan completely differently than the passive investing content suggests, though maybe not the way you'd expect. Their own training consistently starts new operators with one home, proven and profitable, before anything else. But the operators who go on to build real wealth in this space almost never stop at one. They build toward a small portfolio of homes, deliberately. So why does real wealth in this business come from a small portfolio, not a single home? And what does that tell you about how this business actually works? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is well-researched and checked against multiple sources. But research can still contain honest mistakes, and costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific situation. This video is for educational purposes only and is not legal, tax, financial, or business advice. Always do your own research and due diligence before making any business decision. A second note, specific to this episode. Licensing requirements for assisted living and residential care facilities vary enormously by state, sometimes even by county. Verify your specific state's requirements directly before making any decision based on this video. The first cost, the one that splits into two genuinely different businesses, a small residential home and a licensed institutional facility, barely resemble each other financially. The residential model, a house converted to care for a small number of residents, the version most operators start with, typically runs $50,000 to $150,000 or more, using an existing property rather than new construction. Licensing costs scale directly with bed count, and California's structure shows exactly how. A license for 1 to 3 beds runs $495. 4 to 6 beds, $990. 7 to 15 beds, $1,486. A 75 to 100 bed facility, $3,469. The paperwork gets more expensive precisely as the business gets bigger. Larger, purpose-built institutional facilities are an entirely different capital category, commonly requiring 7 figures once land, construction, and specialized safety systems are included. That's the real first decision this business demands, before staffing or pricing or anything else. Are you building a small number of residential homes or one large licensed facility? The economics underneath each path look almost nothing alike. The hidden trap, the one where a single empty bed does real damage. Fixed costs in this business don't care how many beds are actually filled. Facility costs, the lease or mortgage on the building itself, are fixed regardless of occupancy. A 40-bed facility carrying meaningful monthly facility costs needs a real, specific occupancy percentage just to cover that number, before a single other expense gets paid. Staffing compounds that fixed cost pressure. Clinical and caregiving payroll commonly starts around a quarter of revenue, and unlike facility costs, it can't simply be cut when occupancy dips, since state-mandated staff-to-resident ratios exist specifically to protect vulnerable residents regardless of how full the building is. Run the two numbers together and the trap becomes obvious. High fixed facility costs plus high fixed staffing costs means every single vacant bed does outsized damage to the bottom line, In a way, a half-empty retail store or restaurant simply doesn't experience the same way. That's exactly why experienced operators tend to grow into multiple smaller homes rather than one larger facility once their first home is proven. A single 40-bed building concentrates all of that fixed cost risk into one occupancy number. Several smaller homes spread the same total bed count and the same total risk across separate, more manageable occupancy curves. The real engine, the one built on specialization, not just bed count, memory care isn't a nice add-on. It's where real margin actually concentrates. So beyond spreading risk across multiple homes, where does real profit come from? Care level, not just square footage. The national median for assisted living runs around $6,200 a month, with a broader typical range of $4,000 to $7,000 depending on market and service level. Memory care specifically commands $6,000 to $10,000 a month, a real substantial premium over standard care. Because it requires specialized staff training, secured environments, and a level of attention families are demonstrably willing to pay more for. That premium runs 43 to 50% above standard care pricing at either end of the range, for a service that shares most of the same fixed building and base staffing costs already being paid regardless. Specialization doesn't just add revenue. It adds revenue that flows disproportionately to the bottom line, because so much of the underlying cost structure was already committed. The operators building a small portfolio of homes aren't just diversifying occupancy risk. They're building a group where at least one home can specialize in memory care specifically, capturing that premium instead of competing purely on standard rate beds against every other facility in the market. The real money in assisted living. One large facility concentrates your risk into a single occupancy number. A small group of homes, built deliberately once the first one is proven, spreads that risk and captures a real premium on the beds that can specialize. Start with one home proven properly, then grow into more with real intent, not by accident. Run the occupancy math against real fixed costs, and the stakes in this business become concrete fast. Consider a facility where fixed costs require filling roughly half its beds just to break even. A realistic bar given how much of this business's cost base doesn't move with occupancy. At the well-documented $6,200 median monthly rate, that's already a meaningful revenue floor before a single bed above that line becomes real profit. Push a meaningful share of those beds toward memory care instead of standard care, and that same occupancy level generates real additional revenue without adding a single new bed or a single new dollar of facility cost. Purely from the 43 to 50% pricing premium memory care commands. That's the entire lesson sitting inside one occupancy calculation. The building's fixed cost doesn't change based on what kind of care happens inside it. What you specialize in that same square footage does. So let's run the two real outcomes. The optimistic case. You start with the residential home model to learn real operations at manageable scale. Prove that first home is genuinely profitable, then deliberately plan toward multiple homes rather than stopping at one or jumping straight to a large facility. And specialize at least one home in memory care to capture that real pricing premium. Occupancy risk spreads across separate, more manageable curves instead of one large all-or-nothing number. And the memory care premium flows disproportionately to real profit because the underlying cost structure was already committed regardless. The realistic case. You build or acquire one larger facility straight away. Price every bed at standard care rates without specializing any of them, and treat occupancy as a single number to manage rather than a genuine daily discipline. A run of vacant beds does outsized damage to a fixed cost base that never moves. Staffing ratios stay locked in regardless of how full the building is, and the business rides a single occupancy curve with no memory care premium anywhere in the revenue mix to soften a rough quarter. Same demand, same demographic tailwind, same underlying market. The entire gap between those two outcomes comes down to whether the business was built around one concentrated bet or the multi-home, specialized approach the professionals in this space train toward. So is it worth it? If you're picturing the passive investor version, buying a share of a syndication and collecting a distribution, that's a real, different business from the one this video just walked through. What's true is that actually operating a facility remains one of the more durable, demand-secure businesses on this channel, for owners willing to plan at the scale the professionals in this industry plan at. For someone willing to start residential, build toward multiple homes, and specialize at least part of that portfolio in memory care, this can become a genuinely resilient, higher-margin business. For someone building one large facility and hoping standard occupancy alone carries it, the fixed costs in this business don't care how good that hope feels. Last reminder, licensing, staffing ratios, and safety requirements for care facilities vary enormously by state and county. This is not legal, medical, or business advice. Verify your specific state's requirements directly before making any decision based on this video. Remember this: the building was never the business. The occupancy curve underneath it is. Spread that curve across more than one roof, specialize where you can, and the fixed costs stop being the thing quietly running this business instead of you.